All right, let's talk about that first $10,000. You open your brokerage app. Maybe it's 10:47 p.m. You're in bed. The lights are off. You're pretending you're about to sleep, but you're not. You're staring at the little green and red numbers like they're going to reveal some kind of secret about your future. You've got $1,200 invested, maybe $3,400, maybe $7,800 if you've really been grinding. And every time you add another few $100s, it feels like dragging a boulder uphill. It's slow, painfully slow. You read online about people with $250,000 portfolios, $1 million portfolios. They talk about their money making $10,000 in a month like it's just normal. Meanwhile, you put in $500 and the market moves 2% and you've made $10. 10. You could have made more doing DoorDash on a Tuesday night. And you start wondering, is this even worth it? Am I doing something wrong? Why does this feel so hard? I think about this stuff a lot. Honestly, probably too much. My name is Tim, and I spend an embarrassing amount of time thinking about money. Not just how to make it, but why it feels so different at different stages. Why the first few $1,000s feels like climbing Everest, and why later on it feels like you're on a moving walkway at the airport. And here's the thing most people don't realize. The first $10,000 in stocks isn't just financially hard, it's psychologically brutal. But if you understand why it feels that way and what's actually happening beneath the surface, it can completely change how you approach investing. It can change how patient you are, how confident you feel, how long you stick with it. Because the truth, the difficulty isn't a sign you're bad at this. It's a sign you're at the beginning. And the beginning is always the hardest part of anything worth doing. So let's unpack this, slowly, honestly, like we're just talking. Because once you really understand why the first $10,000 feels so heavy, you'll stop fighting the weight and start using it.
When your portfolio is small, growth depends almost entirely on you. Not the market, not compounding, not dividends. You. Let's say you have $2,000 invested. The market goes up 8% in a year. That's $160. $160. That's what? A decent dinner? A couple tanks of gas? So if you want your portfolio to grow meaningfully, you have to contribute more money. You have to earn it, save it, move it over. The growth doesn't feel automatic. It feels manual, like cranking an old well pump. Early investing is basically just a savings game disguised as investing. And that can feel discouraging because we all hear about compounding. We hear about your money working for you. But at $3,000 or $5,000 invested, your money isn't really working that hard yet. It's barely clocked in. It's like hiring one employee and expecting them to run a Fortune 500 company. It doesn't work like that. I remember when I hit around $4,000 invested. I kept checking it every day. I'd refresh the app like something dramatic was going to happen between 2:17 p.m. and 2:19 p.m. And when it moved up $12, I felt weirdly proud and then immediately underwhelmed because $12 doesn't change your life. And that's the emotional trap. You expect it to feel big, but it feels tiny. Here's what matters though. During this stage, you are building the engine. You are wiring the system. Every dollar you put in is increasing the size of the machine that will eventually run on its own momentum. The actionable takeaway here? Stop measuring progress by market gains in the beginning. Measure it by contribution consistency. Did you invest this month? Yes or no? Did you automate it? Did you raise it? That's the win. Because until you hit around $10,000, most of the progress comes from discipline, not compounding. Let's be honest about something. Saving your first $10,000 is not glamorous. It means saying no to things. It means cooking at home when you'd rather go out. It means skipping upgrades, maybe driving a car you're slightly embarrassed by, maybe sharing an apartment when you'd rather live alone. You feel the sacrifice immediately, but the reward? It's invisible. There's this brutal lag between effort and payoff. You put away $500, you feel the $500 gone instantly. But the long-term reward from that $500, that's decades away. It's like planting a tree and being told, "Trust me, this will be amazing in 25 years." Cool, but I want shade now. That delay is what makes the first $10,000 so hard, not because it's mathematically complex, but because it requires delayed gratification at a level most people never practice. And here's the wild part. Once your portfolio hits, say, $100,000, an 8% year means $8,000 in growth. That's real money. That's noticeable. You feel it. But to get there, you have to go through the silent phase, the boring phase, the "why am I even doing this" phase. The key shift? Understand that the first $10,000 is proof of identity, not proof of wealth. It proves you are someone who invests. That's powerful. It's not about the size yet. It's about the habit becoming automatic.
Here's something nobody tells beginners. Losses hurt more when you have less. If you have $2,000 invested and it drops 20%, that's $400. Percentage-wise, that's the same as someone with $200,000 losing $40,000. But emotionally, it's different. Because that $2,000 might represent months of discipline, late nights, overtime, sacrifices. So when it drops to $1,600, it feels personal. You start questioning everything. Did I pick the wrong stock? Should I sell? Is the market crashing? You know what experienced investors feel in those moments? Annoyance, maybe mild concern, but not identity panic. In the beginning, every dip feels like a referendum on your intelligence. This is where most people quit. Not at $100,000, not at $500,000. They quit at $3,000, $5,000, $8,000, because the emotional swings feel bigger than the financial ones. The solution? Zoom out aggressively. If you're investing for 20 or 30 years, a 10% drop in year one is noise, literal noise. But you have to train your brain to see it that way. And that training happens during your first $10,000. Think of it as emotional conditioning. Everyone talks about compounding interest like it's magic. But here's the truth. Compounding is boring until it's not. At $5,000 invested, a 10% year gives you $500. At $10,000, it's $1,000. Still feels modest. But at $100,000, it's $10,000. Now we're talking. The first $10,000 is like pushing a flywheel. If you've ever seen those massive metal wheels in old factories, you know they're incredibly hard to move at first. You push and push and push, and it barely turns. But once it gains momentum, it spins with almost no effort. Your first $10,000 is flywheel territory. You are not seeing the magic yet. You are building the conditions for it. And if you quit before the wheel turns, you never feel it.
When you're just starting, everyone else seems ahead. You see screenshots of six-figure portfolios. You hear about 25-year-olds with rental properties. You scroll past headlines about tech employees with massive stock grants. And you're sitting there with $3,200 invested. It feels small. But here's something important. The gap between $0 and $10,000 is bigger than the gap between $100,000 and $110,000, psychologically. Because going from $0 to $10,000 requires a total behavior change. Going from $100,000 to $110,000 often requires time. That's it. If you can get to $10,000, you have proven you can delay gratification, manage risk, and build consistency. You've crossed the hardest behavioral gap. Actionable advice? Track your progress against your past self, not someone else's highlight reel. Your only competition is the version of you who hadn't started yet. This one surprises people. Early on, your savings rate matters far more than your stock picking ability. If you invest $500 a month, that's $6,000 a year. Even if the market returns 0% for a year, you've still grown your portfolio by $6,000. But if you obsess over squeezing out an extra 2% return on a small portfolio, the difference is tiny. The first $10,000 is built by earning power and discipline, not genius investing. So if you want to accelerate it, focus on increasing income. Negotiate, upskill, take on side work temporarily, reallocate expenses. Once you have $100,000 invested, optimizing returns matters more. But at $4,000 invested, increasing your monthly contribution by $200 has a bigger impact than finding the perfect stock. Here's the part that almost nobody talks about. Somewhere between $5,000 and $10,000 invested, something changes. You stop feeling like someone who is trying to invest, and you start feeling like an investor. It's subtle. You think longer term. You don't panic at headlines as quickly. You start thinking in decades. And once that identity locks in, it doesn't really go away. That's why the first $10,000 matters so much, not because it's a huge financial milestone, but because it cements who you are. And once you believe you are someone who builds wealth slowly, patiently, consistently, the rest becomes a matter of time. If your first $10,000 feels slow, if it feels frustrating, if it feels like you're sacrificing a lot for very little visible progress, good. That means you're exactly where you're supposed to be. The first $10,000 is hard because it demands behavior change before it delivers rewards. It demands patience before it shows progress. It demands identity before it shows income. But here's what I can tell you with complete honesty. Every investor who now talks casually about six-figure gains once stared at a $2,400 portfolio and wondered if it was pointless. They just didn't quit. And that's the entire game. Not brilliance, not timing, not secret stock tips, just staying in long enough for the math to start working for you instead of against you. So if you're at $1,000, keep going. If you're at $4,000, keep going. If you're at $9,200 and it feels like it's taking forever, you're almost there. Because once you cross that first $10,000, something shifts. Not overnight, not dramatically, but quietly. The flywheel starts to turn. And one day, you'll open your brokerage app, maybe at 10:47 p.m. again, and you'll realize the numbers are moving more than you are. And that's when it stops feeling impossible and starts feeling inevitable.
And here's something else that's kind of strange. The first $10,000 forces you to confront your relationship with money in a way nothing else really does. When you're just spending and earning, money feels fluid. It comes in, it goes out. But when you start investing, especially when you're watching that balance crawl upward, you start seeing money as stored time, stored effort, stored discipline. Every $100 in that account is an hour you worked, a dinner you skipped, a temptation you resisted. And that awareness can feel heavy, but it's also empowering. Because for the first time, you're not just consuming your income, you're converting it into something that has the potential to outlive your effort. There's also this awkward middle stage around $7,000 or $8,000, where progress feels slower than when you started. At the beginning, every deposit feels dramatic because you're doubling small amounts. Going from $500 to $1,000, that's a 100% increase. It feels massive. But going from $8,000 to $8,500, emotionally it barely registers, even though it's objectively more money. That psychological slowdown can trick you into thinking you've lost momentum, when in reality, you're just in the quiet build phase. This is where consistency matters more than motivation. Motivation got you started. Systems get you to $10,000. And honestly, the first $10,000 teaches you patience in a way almost nothing else can. We live in a world of instant everything. Instant food, instant streaming, instant notifications. But investing doesn't care about your need for speed.
It operates on years, decades. The market doesn't reward urgency, it rewards endurance. So when you keep investing through boredom, through dips, through months where nothing exciting happens, you're training a skill that compounds just as much as your money does. The ability to stay calm, the ability to wait. That's rare, and rare skills pay off. Another thing, and this is important, hitting $10,000 won't suddenly change your life. You won't wake up feeling rich. You won't walk differently. No one will congratulate you at the grocery store. But internally, there's this quiet confidence. You realize you built something real, something that didn't exist before. And if you can build $10,000 once, you can build $20,000, then $50,000. The number stops feeling mythical and starts feeling mechanical, replicable. That's a powerful mental shift. So if you're in the grind right now, if your portfolio feels small and the growth feels underwhelming, try to see it for what it actually is, the hardest phase you'll likely ever experience in investing. Not because the math is hard, but because you're building the foundation while fighting doubt, impatience, and comparison all at once. And the fact that you're still here, still contributing, still learning, that already separates you from most people who never even start. Keep pushing the flywheel, keep adding to it, keep showing up even when it feels boring. Because one day, and it will happen gradually, not dramatically, the growth will start to feel heavier than the effort. And when that happens, you'll look back at this stage, the first $10,000 stage, and realize it wasn't just the beginning of your portfolio, it was the beginning of your patience.